Hey guys, how are you? This is Ishai Breslauer, your host of the CRE SharkEye Show. Today with us, we have Nikolai Ray, and we're going to talk prop tech. We're going to talk commercial real estate. We're going to talk a bunch of stuff. Nikolai, thank you so much for being with us today.
Ishai, thank you very much for having me.
My pleasure. You know what? Before we start digging into your story, which is pretty cool, I'm sure, and everybody wants to hear about, and we have so much to discuss about markets today, especially today with everything, the turmoil that's going on, and what happened after COVID, et cetera. And where is the market going today? And the shifts, so many shifts. But beforehand, give us a 2-minute elevator pitch of what you guys do today.
Absolutely. So I am first and foremost the CEO of MREX, which is a fintech in the multifamily real estate space. Essentially, what we're doing is we're trying to at least build the equivalent of a Bloomberg terminal, but for real estate investors, for small cap real estate investors, because there's a lot of data and intelligence that exists for mid market and REITs and bigger players, but not really for kind of mom and pop investors and smaller investment companies. So we're building that. I also teach at the MREX College, which is our educational institute. I teach real estate financial engineering. I've been teaching that for about 5 years now. Throughout that as well, I am myself a real estate investor and developer. I have a fully vertically integrated real estate investment firm and general contractor, where what we do is very heavy value add and opportunistic stuff. So we've purchased about 40 apartment buildings in the last 24 months. We have another 10 under contract at the moment. We do about probably 15 to 20 to 25 million dollars in renovations and construction work a year just on our own properties. This is not syndicated. This is our own money. It's a private entity, if you may. And that's pretty much it in a couple of minutes. I have a very eclectic background. I've been doing real estate for over 10 years. Actually, built and sold a very small boutique real estate investment bank. And been all around the world. I'm in Montreal right now because of COVID, but spent a lot of time as well in Miami and the rest of Florida. So,
I think you gave me like 3 days on a row of conversation right now, just by saying what you said. So this is exciting to say the least, and I can't wait. But you know what? Before we even start, everybody likes to. We just spoke about this right before we started. A lot of people want to hear, okay, the guys is telling me he's in the game of real estate. And, you have people who didn't start. I have a lot of listeners who are professionals, who are savvy people, whether they're on the landlord, owner part, CEO. They could also be on the side of brokerage, whether it's finance brokers or deal brokers, doesn't matter, all kind of professionals. And you have also beginners. And everybody gets inspiration from how you got into this.
Mm-hmm. Well, I mean, there are a couple of ways that I got into this, especially where I am at now. I think initially where I kind of got the bug was a couple of my buddies were buying a small apartment building, like it was a 5-plex back when I was, late teens, early 20s, and I was actually a professional hockey player for a couple of years. So I had a bit of money, and they needed help with the down payment. So I said, okay, well, I'm rather than just, waste my money on bars and girls, why not put it into an apartment building, right? And I grew up pretty poor. So I had learned myself through reading books as a teenager about kind of, the whole concept of assets versus liabilities and stuff like that. So I was already kind of on that mental pathway of trying to not live like my parents lived. And do better for myself financially. So did that. That's kind of how I got started. It got me, to kind of have to learn how to underwrite. And I was already a very mathematically savvy human being, if you may. I was probably doing, college level math when I was in 4th grade, just naturally. I've always been really good at math. I think that's my Indian origins. My grandfather was Bengali from the northeast of India. So everyone there is either an engineer or a doctor. Wow. And really good at math. So it's probably where it comes from. But essentially, that's how I got into it personally. But I didn't really do much after that until my mid to late 20s, when I started an investment banking firm in the real estate sector. And that had me working mostly as a professional, well, entirely as a professional in capital markets and transaction and advisory services, financial modeling for very wealthy families, high net worth individuals, private equity firms, and syndicators. And I sold that in 2016. So that was kind of my professional side of things. And then 2 years ago, actually 2.5 years ago, I decided to get back in the game personally and kind of try and repeat the success I had as a professional in the real estate financial engineering space, and try and repeat that as an investor, because I'd done all this work for all these wealthy families, for all these syndications, for all these investors, and helped them, really build their portfolios. But I didn't really have any real estate assets to show. And because I was spending, 12 to 14 to 16 hours a day working on these things and building this investment banking firm, well, I mean, the little free time I had left, I didn't really want to spend it investing in real estate for all those years. So now that I'd sold that, I now had, some free time to actually say, hey, maybe I can start, maybe I can repeat what I did for others for myself.
That's an amazing story. Nikolai, let me ask you this. How old are you, if I may ask?
I'm 37 going on 38.
All right. Good age. Let me just get the clarity of it. You started a real estate investment banking firm or an investment banking firm?
Real estate investment.
So, real estate investment banking firm.
Yeah.
And I could relate to that because I was the head of real estate investment banking at a big firm. And I know what it takes. It's a lot of work. And
it is.
What I want to know is, you started you had the idea on your own to start it, and then you went to start it?
So to give you a bit of a backstory, I played professional hockey till the age of 22. When I retired, I played a couple of years professionally and semi-professionally. And I had a degree in biomechanics with a minor in nutrition, sports nutrition, actually. And I did my postgrad in preventive medicine, specializing in health psychology. So that brought me to, in my early 20s after my hockey career, work in rehabilitation with very big insurance companies, and also work with high-level athletes because I had that athletic background and I had that knowledge base. So I actually ended up going to the Olympics 3 times as the chief of human performance for some of the Canadian Olympic teams, especially in biathlon, which is skiing and shooting. And that was my 20s. But throughout that, I had built a business around that skill set and that expertise. And that business did very, very well, and then ended up not doing so well. And when it ended up not doing so well, that really brought me kind of to an existential crisis of reflecting upon what I wanted to truly do with my skills and with my time and my energy. And I realized that I'd only gone into that field, despite all the success I had. I mean, I was having, in the human performance field, I was having as much success as someone would aspire to have, in their 40s, 50s, and even 60s. I was very, very quick to have a lot of success, but it wasn't satisfying. I found it actually quite boring, and I wasn't motivated by it. So I kept on saying to myself, well, there's something weird here. Like, that's not normal that I'm, at the peak of this field at such a young age, but yet just not feeling it. And I've never been really driven by material things and stuff like that. So I've always been driven by trying to find my purpose and trying to be as valuable as a human being as possible, be it through entrepreneurship or be it through just my own personal relationships or through philanthropy and stuff like that. So my realization was, I really love math. That's why I went into biomechanics, but I was tired of sports and human performance and stuff like that. I'd only kind of gone into that, I guess, to soften the blow from the end of my athletic career. And I realized that I always really had this big passion for finance, and especially real estate, because of the tangible aspect of it. And then I had a very fortunate meeting with a guy who was already in the brokerage field and the capital markets field. And we hit it off. And the entrepreneur in me and the math guy in me, who had a bit of real estate experience, was like, hey, there's an underserved segment of the market here in real estate, where you have real estate brokers, you have mortgage brokers, but there's no one really doing any financial modeling for smaller real estate firms. There's no one really doing any true capital market stuff. And that's when I proposed to him. I said, hey, why don't what do you think of this idea? And he was like, wow, that's a great idea. So, we just kind of went from there and said, hey, let's do it. And, being the pure entrepreneur, like you said, I mean, at first it was 16 to 18-hour days. I ended up in order to make a name for that business and also to be able to have a strong enough proficiency level to build that business, I ended up personally analyzing hand by hand over $10 billion of small cap multifamily transactions. That's one by one, looking at everything that transacted, 5-unit apartment buildings, 25-unit apartment buildings, 100-unit apartment buildings, pulling out the NOI of each property,
that's
calculating the
performance.
cap rates. that is, it's 10,000 hours of performance, essentially. That's essentially what it is. And that's how I really got into real estate.
That's an amazing story. How many people, meaning you started with obviously you and your friend, when you sold the company, how many years it took to sell it?
2.5.
2.5.
How
many people?
3.5.
Okay.
3.5 years, and we had a staff of somewhere between 10 to 15.
Nice. Beautiful.
Yep.
Wow. Yep. Very, very nice. And which markets you guys focused on?
We focused on the province of Quebec. So essentially Montreal, Quebec City, and the other markets around there.
Beautiful. A market that I don't know much, but I'm sure it's exciting.
Beautiful place. It's actually the Canadian capital of multifamily. A lot of people think that Toronto or Vancouver would be the most important multifamily markets, but Montreal actually is, just because of culturally, there are a lot of apartment buildings in the province of Quebec, and a lot of tenants.
That's amazing. So you sold that company, and then you started doing things on your own, obviously. What was the next step? Where did you get into?
So I sold that company initially, essentially because I didn't see eye to eye with my business partner. He was happy making, $200,000, $300,000, $400,000 a year, and just like keeping it at that. Whereas I'm a builder. I like, I'm an entrepreneur. I'm an innovator. I like building cool stuff and stuff that's different. So for me, that wasn't, for him, that was like, oh, we achieved. And I was like, no, we're just getting started. Like, that's not what I want necessarily. And as I was building the firm, I kept on hitting my head against a couple of very similar problems. And the number one problem was I felt like there wasn't much access or transparency to data in the small cap multifamily market. So anything under, say, 50 to 100 units. So from 5 to 50 or 100 units, there's not much data. Like over 100 units, there's a lot of data. You have co-stars and Reonomies and all this stuff. But under that, there's not that much data, number one. Number two, I kept on coming back to the thought of, why is it that there's no centralized marketplace? Why is it that if I have $300,000 to invest in multifamily real estate today, and I'm not a real estate expert, and I don't want to become one, why is it that I can't just go somewhere and see all the inventory and make a decent decision? Why is it I have to go through all these hurdles and loops, and have to go on Zillow and LoopNet and 10X and Crexi, and then off market, and then onto all the brokerages, the big brokerages and wholesalers? Like, why is it that it's so complicated to get access to the market if you're not an insider, despite this being such an important asset class? And that's kind of where the idea of like kind of a Bloomberg terminal / Expedia or Zillow of multifamily came into mind. So that all came together, and I'm just like, you know what? I told my business partner, listen, I'll sell you and the first 3 employees my half of the business. I'm going to go and build something else. And that's when I went off and started the MREX. So initially, I wanted to build this technology platform. And as I started building the technology platform, I started posting on Facebook and on social media, just my daily thoughts, because there was a 6-month period where I was essentially retired, where I couldn't start another business until my sale of the first one closed. So I was in my early 30s with not much to do. So I just started kind of thinking and sharing my thoughts on social media, which was not a thing really back then, especially not in Canada, maybe a bit more so in the US. And that just turned into the realization that, wow, there was a big discrepancy in the education in the market. So if you want to learn how to invest in multifamily, or if you want to learn how to invest and perform, what I call, searching for alpha, well, there's a big discrepancy, because on one side of the market, you have all these gurus and the seminars and the conferences and the coaches. And I don't say that in a bad way whatsoever. I think a lot of them are doing a great job, but it's very on the surface. It's not always 100% objective. And then on the other side, you have colleges and universities. But I mean, if you decide that, tomorrow morning you want to start investing in multifamily real estate, unless you have a degree in finance already, you're not going to go back to college or university to do a degree in finance or in real estate development. And anyway, that's probably better to get a job, whereas it's not suited to become an investor. And then if you do go to the coaching conferences and seminars and stuff like that, well, like I said, a lot of it's very kind of introductory or superficial, and it doesn't have that more, academic or theoretical or scientific base behind it. And so I started on the side of my technology company, an educational institute, essentially. And that was that transition period.
That's an amazing thing. And as a guy who made also an online course about not multifamily, but commercial real estate takes one to know one. And it sounds like you have so much to give to others, which is incredible. But I would like to divide everything that you just poured on us to 3 sections, okay, to make it more, I would say, educational or informative for everybody who's listening.
Absolutely.
One part, and we're talking about what you do today, okay? And one is the real estate part, which we're going to talk about right now, what you're involved in, what type of deals, how you're getting into deals. Are you more on the LP private equity side or the general partner side or both? Or what do you do? That's one conversation. I would like to get into that. The second conversation, which we're going to have, I would like to talk about the prop tech side of things. That would be the next, when we shift gears, we're going to talk about that. I would like to make it about that and to dig in about this, about what you wanted to do as the Bloomberg terminal for, the small cap multifamily sector, as you called it. And the third part I would like to talk about is the educational part. Of course, I'll leave that to the end, but and that is exciting. So let's start first of all about what you do today in terms of real estate. What type of deals? What role are you playing? Are you a general partner? Are you more on the private equity side, looking for sponsors? Where are you with that? And type of deal, size, et cetera, locations.
Pretty simple, actually. Like so me and 2 buddies invest together. So one is an engineer, and he's a general contractor. He has his general contractor license, and the other is essentially a doctor, a radiologist. So
what a combination!
Yeah. So we're 3
One
buddies.
is a financial guy. One is one is an engineer, construction guy, and the third guy can just see through everybody.
Exactly. It's a good partnership. So we just started essentially a joint venture partnership between the 3 of us, and it started with, hey, I had a deal on a 7-unit apartment building. And well, it was kind of a joke. My buddy was the broker who had listed the property. So I sent an LOI to just kind of, play around with him. And this was about 2.5 years, a bit less than 2.5 years ago. So ended up going through the whole process. And I got to the point where it was too late to drop the LOI because I didn't want him to look like an idiot. I didn't want to look like an idiot towards my buddy. And these 2 guys, my buddy engineer and my buddy doctor, well, the engineer was actually one of my students. So I actually taught him real estate financial engineering and analysis and modeling. So that's how we met, but we kind of kicked it off. And I'm not a manual person, so I needed someone who could, do the heavy lifting and the actual construction work. So I knew that if I did eventually buy my own properties, it would probably be with him, because I wanted to kind of, leverage that kind of aspect of things. And then my doctor buddy had always told me, hey, if you invest in real estate, let me know. I'm in. So gave them both a call, ended up buying the 7-unit apartment building together. We paid, it was essentially a crack house. So it was across the street from an elementary school, from a grade school. And one of the apartments was essentially a crack house where you had these Nepalese immigrants selling crack cocaine out of their apartment.
Wow.
So it was a pretty rough apartment building. but it had good bones. So what we did is we ended up paying about $420,000, which was not a lot, but it was a rundown apartment building. And we ended up putting about $700,000 in renovations in the property within, a 4-month span. So we essentially, got all the tenants out of the apartments, and then just stripped the whole property, redid everything: plumbing, electricity, divisions, insulation, everything that you can think of. We pretty much
kept the frame. That's how it sounds.
Kept the frame and the foundation. That was it. So and then we refied out of that, made a nice profit. And as we were doing this, well, my other broker buddy is like, "Hey, you're buying apartments now?" And I'm like, "Yeah." So he sends me an off-market deal that was an even sweeter deal, a 10-unit apartment building that had just been bought out of bankruptcy. So we paid $550,000 for that. We only had to put $50,000 down because the seller actually financed us the other $490,000 or $500,000 on the property. And that's a property that we just finished renovating a couple months ago. We put about $1.3 million into it, and now it's worth almost $3 million. So same kind of thing. We just redid absolutely everything. And essentially we've done that now. So we've purchased in the last 26 months or so, I guess, 40 of those types of deals, pretty much.
Wow.
So we've done 40 of those types of deals.
7, 10 units, 15 units, that kind of stuff.
5 to 12 units.
Oh, wow.
Okay. And we also buy stuff like maybe a triplex, but that the zoning allows for the construction of a 12 unit. So we'll knock down the 3 unit. We'll build a 12 unit on that instead. We
also have to rezone also? You went to rezoning also?
Yeah, we rezone.
And how is the process in that area in terms of rezoning? How long it takes?
So what I try and do is most of the time I'll try and actually just arbitrage off the actual zoning laws. So if the zone is zoned 12 units, I'll look for all the houses and duplexes and triplexes in that zone. And then it's not that hard of a process because it's already zoned 12 units. Right. It's just that it wasn't built properly.
Right, it gets the permits. Yeah.
Right, exactly. Whereas one of the deals that we're building right now is we bought a warehouse. And we went through the whole rezoning process of that warehouse property, and we ended up knocking that down. And now we're building 8 6-unit apartment buildings, so 48 units essentially, on a deal that we paid. We paid $225,000 for that warehouse. I mean, just the land now is worth about $1.3 million just because we were able to rezone it.
So basically, what you do is you take your own money, you don't syndicate much. You take a few other partners, and that's it. You go, I guess you take some bank financing. What's your leverage usually?
So we use a mix. So most of the money, I'd say probably up until the first 25 deals was all our money. And then I believe at around maybe deal 25 or 30, we took on 3 friends. So each friend maybe put some money in one deal, one put it in another deal, one put it in another 2 or 3 deals. But essentially, we own about 90% of our properties. We own about 90% of the equity. And then we use, either bridge financing, hard money lenders. We've used a lot of seller financing as well. So
then refi.
And then we refi out of that. So, we're essentially leveraging anywhere between, sometimes we'll leverage 0. Like we buy some properties cash.
Wow.
And put 0 leverage on it just because we know we're going to knock it down and then build up something. Other properties we leverage up to 100%. So I'd say the average is probably around maybe 65 to 75, 80-ish. And then once we refi, no, not bad at all. And then once we refi, I mean, we have properties that we have, less than 50% leverage on them.
First of all, it's very interesting. I think that your method is exciting. And it's, I think it gives people hope that you don't always need to go leverage out, get LPs, etc., which is a beautiful system, obviously, to go and raise capital of other people. But some people do have the money and they're so lost. And by taking 1 or 2 or 3 partners, you're done. You don't need to take much. You don't need to do much. You're basically in a good shape. And I think that's beautiful. The next thing I would like to discuss is your fintech, obviously your exciting company that you got involved with. And and we understand why you got involved with it, but I have so many questions about it. So if you could, first of all, elaborate about it, and then I'll take the questions from there. The concept, if you could like remind us what we spoke about a second ago, the Bloomberg terminal concept for small cap properties.
Yep. And if you don't mind, before we jump to that, actually, what you just said made me think about something that I think is not talked about enough. Like how you said that you don't necessarily have to syndicate, because I think right now in real estate, the whole syndication model is very popular, right? Everyone and their grandmother is syndicating right now, right?
Yes.
And everyone's a syndicator, and I get it, right? Because it's a great way to get fees and essentially live off of real estate, even though you don't have maybe enough equity placed in real estate to live off of your own cash flow, right? So
yes,
it's a great way to kind of get out of your W-2 job and do that. But it's also essentially a business and a job, right? And you're replacing your W-2 by another job. You're just now working for yourself, and essentially while you're working for your investors, which is a good thing. I have no problem with that. I have no quarrel with that whatsoever. But I think a lot of people get caught up in the fact that they have to do all these big deals and raise all this big money. And I think most people getting started out in real estate, if they just want to get started out and they don't want to be an LP, or they want to be an active investor, but they don't want to start having to raise all this money and do all these big deals. There's no shame in buying a 5-unit apartment building, or there's a loan, or there's no shame in buying an 8-unit with a friend or with another person and doing a small joint venture.
100%.
I think there's no shame in that whatsoever. And I think it's actually a great way to learn and a great way to apply what you're learning maybe in courses, apply it, get that experience, and be a better syndicator if you do wish to syndicate eventually.
Because you have experience with the actual deal.
Of course. I mean, if tomorrow morning I wanted to syndicate, I mean, it'd be a walk in the park, because I'm going to LPs and I'm saying, hey, I'm syndicating this 400-unit apartment building. Do you want to get into my syndication? Okay, who are you? Well, apart from, my resume and all that stuff, well, I've bought 40 apartment buildings in the last 24 months with my own money, and I've turned them all around. That's a powerful thing. And that obviously that's
very powerful.
That's an extreme, but I mean,
right?
let's take two people who, well, what's your experience? Well, I've never done any real estate. I've just done a coaching or gone through a seminar, versus, well, I already own a 5-unit that I've had for 2 years, or, I own 3 or 4, quadruplexes or 6 or 8 units, and I've done a good job managing them. Well, hey, that's a good base to go off of, right?
It just teaches us that there's so many ways to get into this business. It's beautiful.
Absolutely. So on the fintech side of things, as you asked, so what we've done so far is we've built a mobile app that essentially is essentially doing 2 things at the moment. What it does is it's centralized all apartment buildings into one place.
In certain location in Quebec, or is it?
So for now, what we've done is we've used kind of the beta in the province of Quebec. So what we've done is we've essentially aggregated. There's about 60,000 apartment buildings of 5 units and plus in the province, which for Americans, the province is essentially the state. So just imagine whenever I say province, I'm saying state.
Okay.
But essentially in the state, there's about 60,000 apartment buildings. So what we've done is we've aggregated all the 60,000 apartment buildings into a database. And then we've got data from a whole bunch of different sources and created a unique database. And what we've done from that is we've created essentially a search engine that you can enter an address and search for a property, or you can go on the map and just search for apartment buildings, whether
just like
they're on sale.
CoStar, or like you said, Reonomy, or et cetera, et cetera.
Right. And
that's for those properties. Yeah.
And if they're on sale or they're not on sale, you can still find the properties and you can find all the information. And then we apply all our models onto those properties to help, number one, do a first level of underwriting for you. So you don't have to be a strong underwriter to already kind of see how this property, what's the potential of this property? How could I purchase this property? What are the different scenarios? And kind of like how various platforms offer signals to investors in the stock market, be it like Motley Fool or or Real Vision or those platforms, Hedgeye and stuff like that. So we're essentially already doing some of the legwork for investors. And then if you are more of a sophisticated investor, you can actually just pull the data from there directly into the second screen of the app. And then you have your full underwriting tool that allows you to actually start model your acquisition.
So let me ask you this. Are you guys actually going property by property and putting the data, or do you have an AI system that takes the known data or whatever you guys put together and that sort of calculates into the pro forma?
Well, so I mean, AI is kind of a buzzword that's thrown around a lot, but yes, there's
automatic. Let's call it automatic.
There's machine learning or deep learning.
Machine learning, yes, best.
Right, absolutely.
So that's very good because, going through each and every one of those and do that, that's very, very difficult. But if the machine learning process is taking those fairly simple, properties to digest, and take them and put the number out, that's brilliant, especially for people who look at their property, those properties, and many of them are not that savvy. So I think this is a great idea.
Absolutely.
It reminds me, there's another a company, actually an Israeli-based company that raised a lot of capital and they're very successful. Skyline, I think AI, I think that's their name.
Right.
So is that similar to that concept or less?
No,
because they're more due diligence-y type of.
Less so. What they're essentially a real estate fund that's powered by AI, right? So what they're doing is they're using AI or deep learning essentially to try and find discrepancies in value in various markets or properties, acquire those properties for their fund, and deliver alpha to their investors, right?
I see.
Whereas what we're doing is we're trying to be the market, essentially. We're trying to
give information.
Right. We're creating a marketplace. We're educating or informing everyday investors. So we're not actually, buying properties or stuff like that.
That's beautiful. Tell me something. What would it take for that type of terminal? And I'm sure you have some competitors. I'm not that familiar, but I'm trying to think if I know of any or et cetera. But what would it take to go into the United States of America and do it, let's say, in the New York area, which is very difficult to do that?
Essentially, just time and money. So that's actually a great question. So when I started this business, I started with my own capital. I didn't raise any money from angel investors, didn't do a seed round, nothing. Like there's zero outside capital in this company. And essentially,
this is amazing.
And essentially what happens is that the infrastructure is there in place for the US. This startup's been built for the US and Canada, essentially. So it's just a question of starting to go and pull the data sources and build our own database for the US. That's all that's really missing for that. Which is essentially capital. But before raising capital, I wanted to make sure that there was a functioning product, essentially, and that there's product market fit and that it's doable and scalable, essentially. So essentially, all that would be missing is that raise a couple million and throw that into data acquisition, and the machine's already there to swallow all that data up, and then put it into and then create our own unique database with that. So that's essentially the model. And because it's very niche, it's a niche product, and I'm a very long-term type of entrepreneur where I'm not looking to get rich quick, I'm already more than well off. I could stop tomorrow morning. I'm good for the rest of my life. So I'm very into building things the way I want to build them and creating value through those things. And I'm not in a rush.
Which is beautiful.
So there are indirect competitors. Reonomy might be considered an indirect competitor. Obviously, CoStars and Zillows and all this. But I think we put too much value on competitors because a lot of people just copy what everyone else is doing. But I think you're able to have competitors, but do something so unique that there is an avatar or a type of user that no matter the existence of CoStar or Reonomy or LoopNet or whatever the other types of things that exist out there. There's a whole bunch of, fintech companies in the real estate space. If what you're building attacks a very specific problem in a very applicable way, you're good.
Tell me something. What type of staff do you have in your business?
So we have a CTO who's obviously a very, very high level engineer with a lot of leadership. We have a full-time CFO who was actually the chief innovation officer for Canada's equivalent of Fannie Mae.
Oh,
so
wow.
very high level person, PhD with a whole bunch of postdocs in economy, and obviously myself. And then we have UX team, so UX designers, and then we have all the programming team. So we have back end engineers, front end engineers, and then the data guys. So we have about
How many
a team
people?
of 1 to about 10.
Good. Sounds like you're going somewhere, please God. And it sounds like this is you got something there. Sounds like you got something there. Obviously, that type of business, in order to scale, just like you said, once you have a good system going, once you have a good, I would say, flow, and you know how it works, and you can copycat this whole system to another place, all it takes is capital. And once you know what type of capital you need for each location, obviously the United States, different capital is required for Omaha and New York, obviously.
Right.
But,
absolutely.
But that's what you will need. I mean, that's what you'll need. Some places you'll be able to still run things from Canada. In some places you'll need a hub. And, and that's the way it is. But it sounds like such an exciting idea, especially for people who want to get into the smaller deals. I think this is a blessed thing and beautiful. And I wish you all, all the best with that. That sounds amazing.
Thank you.
Sounds amazing. And you know what? And everybody who's listening, by the way, you guys are every once in a while I get someone who is involved in prop tech, and here you see Nikolai is doing something really, really exciting. And you know what? Sometimes all it takes is to jump in. You listen to a podcast, and you connect with someone, and you take an opportunity. Sometimes that's all it takes. And that sounds like a beautiful idea. You know what? I want to shift gears a little bit and go to the educational part of things. Okay. And you know what? Before we go to the educational part of things, pause. Let's pause it for a second. We'll talk about it in a second. I want to ask you something general about the markets, and what's going on in the markets. Where do you think we're going today? And let's discuss mostly, meaning no crystal ball, nobody holds it. But where do you think we're holding today? And you are a multifamily guy. So, it's such a crazy time today, such crazy times today. And we'll talk more about this, but I would like to get the ball rolling and give you that, that ability to talk about that.
Well, I'm a multifamily guy, and obviously I'm an entrepreneur, and I guess now you could kind of say I'm a tech guy, but I mean, at heart, I'm a finance guy, right? I love finance. So obviously, I also like economics, especially macroeconomics. So I wouldn't say, I'd never consider myself an economist, but I don't know, I'd want to be one.
You know what? I'll tell you one thing. As a guy who watches constantly, and I'm not an economist and I'm not a finance guy, but I know finance, and especially meaning real estate finance, obviously. And I can tell you this much: I'm a guy who constantly researches. I made a research about the Great Depression and a lot of research about the 2008 recession. What one went on. I watched a lot of movies about this and a lot of details about this, and read a lot of material to make sure I understand the flow of how things got collapsed.
Yeah.
And it's really interesting. And obviously this was very, very different than, what went on during COVID, because this was not a real estate driven problem. This was a totally different issue. But we are in a situation today where cap rates are going lower and lower and lower. Obviously, multifamily is the most resilient asset class, but within that asset class, you have different type of classes and different type of thought process and different type of deals, whether it's more value add, more, core plus, whatever you call it, different approaches. And that's what I want to, as a finance guy, what is your take on that?
Well, and not to throw tomatoes at my economist friends, because I have a lot of economist friends and I have a lot of respect for them. But I think us finance people are a bit more kind of mathematical and a bit more a bit more, a bit less abstract. But essentially, the way I see it is, I think cap rates are going to hold even if interest rates rise. Now, do I think interest rates will rise in the short term? I think obviously what the Fed is looking to do, interest rates will probably rise, and I don't like to say things as absolute. I think it's all a game of probabilities, but I think they will probably rise. I think it's a mistake. I personally think that the Fed shouldn't raise rates, and I think it will be very short-lived. I think the minute that they raise rates, 1, 2, now they're talking about even 3 times, I think what's going to happen is that the markets are going to react very, very negatively. And the reason being is I think we're actually, inflation is not really the problem. I think deflation is the problem. You know, we're still in the same euro dollar shortage that we've been in since 2007. And for people who don't know what the euro dollar is, this essentially is American dollars parked in banks outside of the US, right? That's essentially how the economy works. There's still a shortage of dollars, and that's not going anywhere, and it hasn't been fixed. And the Federal Reserve and all the central banks printing money, they don't actually print money, right? The Fed doesn't print money. What they do is they essentially create reserves, which then they trade to banks for treasuries. And normally, in the way the system was supposed to work through quantitative easing, is that these commercial banks would, essentially take that and make out more loans, right? And do more loans. And that's how you create money, essentially, in the market. But what they've only been doing is essentially buying more treasuries and selling them, trading them back to the Fed for more reserves. So there's not actually any real money creation despite all this quantitative easing. Now, that's why I think essentially deflation is probably what we should be worried about in the mid to long term, much more so than inflation. Now, I don't have a crystal ball, like we said, and I'm just a finance and real estate dude, right? So what the hell do I know? Either way, I think multifamily is a very good asset class to be in. You got to be in any asset class anyway, whether you're in deflation, inflation, whatever. An investor is invested. You can't sit on the sidelines. And I think the one thing to keep in mind is, despite all that's going on the macroeconomic side and even in microeconomics, the one thing that you have to keep in mind as an investor is, hey, as long as you can service your debt, you can ride out pretty much any storm. So watch your leverage levels, and especially watch your DCF.
Most important thing.
Right. Watch your DSR levels, debt service ratios. And if you can protect your cash flows at that level, well, you're protecting yourself against most of that risk, right? And then, whatever happens to the market, well, then that's a crapshoot, essentially.
Obviously, and what you said is very, very interesting. You said that we have to worry more about deflation. Right now, there's inflation going on. That's without a doubt. That's right now what we see. In order to understand,
because of supply chains and because of helicopter money, right?
Of course, the helicopter money is, I think, one of the things that everybody loves, but at the same time, it's one of the biggest mistakes in terms of how to use money. It was necessary in the very beginning. It was necessary maybe even later, but at a certain point, you got to know when to stop it. It would keep people from going back to work. It would keep people from doing the right thing, from investing correctly, or it will keep, it's good when the markets are frozen, when the pandemic hit and nobody knew where we're going, and et cetera. But you obviously have to know where you're going. And the inflation is caused by that. Deflation obviously is what this is like the main term when it happens, that the market is basically going down and down and down and down and down and down and down, where, a depression can come about, when or something really extreme can come about. Yeah, go ahead.
I think a lot of people get inflation and deflation, all these things. These are terms that are used very loosely, right? So it's hard to, if you take an Austrian economics view of things, you'd say, kind of like the Peter Schiff, the gold guy who's like, it's inflated because, essentially they've deflated the value of the dollar because they've printed so much money, blah, blah, blah. And then you can look at the stock market and say, well, we're going through inflation. Most people will look at consumer price indexes and, how much gas costs, how much food costs, how much rent costs, right? That's what inflation is to a lot of people. Now, I'm not saying there's not inflation on assets, I'm not saying that whatsoever, but I think the inflation on goods is transitory. I'm gonna stick with that, even though Jerome Powell hasn't stick with that. I think it is transitory, and I think.
Can you explain that? It's transitory in terms of what?
Well, I think it's because of supply chain issues and because helicopter money was dropped on people. But the minute the supply chain issues ease and come back to normal, the minute that people actually have to go back to work, well, that inflation will have been transitory, and we're not going to keep on seeing 4, 5, 6% year-on-year inflation, because you have to remember that means that next year we're going to have another 4 or 5% over the 4 or 5% that we've already had. Like that's I don't see that happening. I don't see that. I think GDP is nowhere near it should be. I think GDP over the last 10, 12 years has actually not grown as much as it should be. And if there's no GDP growth, where the hell is the inflation coming from? Like I said, the banks aren't, they're not really printing money. They're just playing this kind of, risk management, risk aversion retrade game with the Fed and with central banks. And there hasn't really been that much money creation in the system, and especially money creation going towards growth, GDP, right?
So you're saying basically that what we see today is going to adjust itself basically and fix itself, obviously.
I think so. Yeah.
Okay, that's an approach. But the one thing I love what you said, inflation is as bad as it is, and it is bad, without a doubt. It is bad. Things that aren't stable are bad, whether they're on this side or that side. But inflation is bad because, like you said, every consumer good is going up and up. And this costs more, gas costs more, everything costs more. Deflation presents in the very end of it, the very extreme end of it, no milk in the store. And that is like the very extreme part of it, I guess. But, going back to what we spoke about in markets and real estate, et cetera, I think that, today's environment, obviously, and that's why I talk about it a lot, that the multifamily was affected mostly by, the office, residential are basically correlated. The less office, more residential, more housing in terms of more larger homes, more square footage on the homes, more single family homes, more suburbia, et cetera, like that, or more, I would say, suburban office, less urban office, et cetera. That will change again, meaning people will go back to the cities. It's a matter of time. But that was affected. And on the other side, you have the retail industrial, less square footage on the retail, more, in terms of industrial and, distribution centers, et cetera, because of the e-commerce revolution. So that's what I think.
And on the
any take on that?
And on the multifamily space, you have to understand that cap rates, and this is a big fallacy that a lot of people believe, that cap rates are driven by interest rates, which is not true. Like all the research shows, all the studies that have been done on this show that interest rates do not drive cap rates. Yes, in the mid to long term, they influence cap rates, but they don't drive cap rates. What drive cap rates is movement of capital. Basic economics 101, supply and demand. How much money is searching for deals, right? So even if interest rates do rise in the next year, if there's still the same amount of money searching for the same amount of properties,
cap rates will go down.
Cap rates will go down. Well, at least they'll stay the same. They won't be going up, right?
Right.
So obviously, if interest rates rise, by 200-300% and stay there for 4 or 5 years,
it'll drive people off.
It will influence the market, but interest rates don't drive cap rates, and I think that's one thing people have to really keep in mind. So yeah.
Love that perspective. I want to shift gears a little bit, and before we set our goodbyes, talk a little bit about your educational system.
Sure.
Go ahead.
Essentially, what it was, like I said, is I was talking a lot about, various ways to manage risk or maximize returns in multifamily, searching for alpha, but without actual alpha, because I think a lot of people mistake alpha where they're like, well, he's getting more returns, he's generating more profits, so he's generating alpha. That's not true. It has to be risk adjusted, right? If you're taking 20% more risk to generate 20% more returns, you're not really doing better than the other person, right?
Right.
You're just taking more risk, and thus you're getting the equivalent higher returns for the risk. So just as I was talking about this stuff and all these various theories that relate to real estate financial engineering, and what real estate financial engineering is essentially the umbrella under which, everything that's mathematical that you use to find a solution to a problem in real estate, essentially is real estate financial engineering, right? Underwriting, modeling, those are all parts of real estate financial engineering. So as I said, I saw that in the market there were coaching programs and seminars, which are very, practical, introductory, motivational, but they don't go very deep into the mathematics and the analysis and the actual kind of science of real estate investing. And then obviously on the other side of the spectrum, well, colleges and universities. But I mean, unless you want to become an appraiser or an investment banker, no multifamily investor is going to go back to school, back to college to do a degree. So I figured, hey, let's build something in the middle where you have, university level pedagogy and education, but in a very applied manner and very specific manner to real estate investors of all backgrounds, whether you have a degree in finance or whether you have your grade 12. How can we teach you to be a better real estate investor? And that's kind of the genesis of the MREX College, which is we're bringing you, university level and quality education to everyday mom and pop investors in the small cap to mid-market level.
Beautiful. So you guys heard it. You know what? You want to learn about multifamily, you want to get into this whole arena, you got Nikolai's college and you can learn more about it. You know what? Before we say our goodbyes, first of all, I want to tell you that I enjoyed this interview really very much. And I'm sure everybody who's listening to us is really enjoying it. And thank you for this.
You're making me realize how busy I am. Like I'm talking about all this stuff. Like, geez, I need.
That's how it is. People don't realize how involved they are in certain things until they actually start elaborating. Tell us how people can find you, whether it's for the university, for the education, or if they eventually want to invest with you or want to learn about you more or connect with you. Tell us a little bit.
I'm on all social media, so be it Facebook, Instagram, LinkedIn, TikTok. So whatever is your favorite poison, I'd say go for it. I also recently started my YouTube channel. I actually have a vlog. I've already done a couple episodes where I have someone follow me around in my real estate investing, my actual properties. So that's
amazing.
Cool. Yeah, that's pretty cool to see. It's called Alpha Investor. And obviously the MREX College, same thing. You can go to mrex.co. You can follow MREX College on all the various social media platforms. We produce a lot of content. I share a lot on social media as much as I can, obviously being a very busy person and not being a full-time social media influencer, but actually being someone who's in the trenches. So yeah, that's probably the best way to get in touch with me and see what's going on.
Beautiful. And you guys can see the links below, and you can go and learn more about Nikolai. This was really exciting. Nikolai, thank you very much.
Thank you, Yishai. Appreciate it.
No problem. You guys,